Why Warren Buffett is sitting on $325 billion. Warren Buffett is sitting on a mountain of cash, $325 billion to be exact. That's more cash than the GDP of most countries, more than the entire market cap of companies like Netflix or Nike. And people are asking, why? Why would the greatest investor of all time leave so much money sitting idle? Critics say he's lost his touch, that he's too old to understand modern markets, that he's missing out on the AI revolution, the crypto boom, and the next big thing. But what if they're all wrong? What if this massive cash position isn't a mistake, but rather the most calculated move of Buffett's career? Today, we're going to dive deep into Warren Buffett's cash strategy. We'll explore why he's holding this unprecedented amount, what he's seeing that others aren't, and what this means for investors like you and me. Because once you understand his reasoning, you'll never look at cash the same way again. The Buffett philosophy: don't lose money. To understand why Buffett is holding so much cash, we first need to understand his core investment philosophy. Buffett has two rules that he's followed for over 70 years. Rule number 1, never lose money. Rule number 2, never forget Rule 1. This isn't a joke, it's the foundation of everything he does. Here's the math behind it. If you lose 50% of your capital, you need to make 100% just to break even. That's not a favorable trade. This is why Buffett is obsessed with not losing money first and making money second. So how does this relate to his current cash position? According to Berkshire Hathaway's latest SEC filings, Buffett has been steadily reducing his equity positions since 2021. He's been a net seller of stocks, not a buyer. Why? Let's look at the valuations. The S&P 500 is currently trading at a Shiller P/E ratio of around 33 to 33. The historical average is approximately 17. That means stocks are roughly 80% more expensive than their long-term norm. In his annual letters to shareholders, Buffett has consistently emphasized the concept of margin of safety, a principle he learned from his mentor, Benjamin Graham. The idea is simple. Only buy assets when they're selling well below their intrinsic value. So even if you're wrong about some things, you still have a cushion. At current market valuations, that margin of safety has largely disappeared. Companies are priced for perfection. There's little room for error.
During 2021 and 2022, Buffett sold significant portions of several holdings, not because these were bad companies, but because they had become expensive. He made excellent returns, and he moved on. This is classic Buffett. He'd rather miss out on overpriced gains than participate in inevitable losses. Cash as strategic optionality. Here's what most people misunderstand about Buffett's cash position. It's not dead money, it's strategic ammunition. When you're fully invested, you're a price taker. You must accept whatever the market offers. When you have cash, you're a price maker. You can wait for your price. Let's look at a real example from Buffett's playbook, September 2008. The financial world was collapsing. Lehman Brothers had just declared bankruptcy. AIG was on the brink. Credit markets were frozen, and panic was spreading through Wall Street. In the middle of this chaos, Buffett received a call from Goldman Sachs CEO Lloyd Blankfein. Golden needed $5 billion urgently. This wasn't a normal capital raise. This was a desperate call for survival. Buffett had the cash. Golden didn't have options. So Buffett structured what would become one of the most profitable deals of his career. $5 billion in preferred stock, 10% annual dividend, warrants to buy an additional $5 billion in common stock at $1.15 per share. When the dust settled, this deal generated approximately $3.7 billion in profit for Berkshire, a 74% return in just a few years. But here's the critical point. This opportunity only existed because Buffett had cash when no one else did. Invested in September 2008, Buffett would have had to sell assets to buy Goldman. And what would he sell? Everything was down 40–50%. He'd be selling at the bottom to buy at the bottom, just moving money around, not creating value. Cash gave him the optionality to act when everyone else was paralyzed. The same pattern repeated in 2020 during the COVID crisis. While others panic sold, Buffett deployed capital into opportunities like Japanese trading companies and additional shares of Occidental Petroleum. This is what financial professionals call dry powder, cash reserves ready to deploy when opportunity knocks. In Buffett's own words from his 2023 annual letter, "We only swing at pitches we like." And right now, he's not liking many pitches. What Buffett is seeing now. So what exactly is Buffett seeing in today's market that makes him so cautious? First, unprecedented market concentration. 7 technology companies, Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla, now comprise approximately 30% of the entire S&P 500's market capitalization. This level of concentration is historically unprecedented. Now Buffett himself owns a massive position in Apple, it's Berkshire's largest holding. He clearly believes it's a quality business, but even quality businesses can become overpriced. Second, euphoric sentiment. Market sentiment indicators show extremely high levels of optimism. The VIX volatility index has been subdued. Credit spreads are tight. Everyone seems comfortable. Buffett has famously said, "Be fearful when others are greedy, and greedy when others are fearful." Right now, there's very little fear in the market, and history shows that Buffett makes his best investments when others are fearful, not when they're comfortable. Third, the interest rate environment has changed. For over a decade, near zero interest rates made stocks attractive by default. Bonds paid nothing, so equities looked good in comparison. Now, Buffett can earn approximately 5% on treasury bills with zero risk. That $325 billion generates about $16 billion per year in risk-free interest. This changes the calculation. When comparing stocks to bonds, the bar is now higher. Stocks need to offer significantly more than 5% expected return to be attractive. At current valuations, many don't meet that threshold. Fourth, historical patterns. Buffett has studied market history extensively. He knows that markets are cyclical. Periods of euphoria are inevitably followed by periods of despair. Looking at historical data, .com crash, 2000–2002, Nasdaq fell 78%. Financial crisis, 2008–2009, S&P 500 fell 57%. COVID crash, 2020, S&P 500 fell 34% in weeks. Each time, those with cash were able to buy quality assets at distressed prices. Buffett doesn't know when the next downturn will come. It could be next month, next year, or 3 years from now. But he believes, based on historical patterns and current valuations, that significant dislocations are more likely than not in the coming years. And when that dislocation comes, he wants to be the buyer, not the seller. Fourth, historical patterns. Buffett has studied market history extensively. He knows that markets are cyclical. Periods of euphoria are inevitably followed by periods of despair. Looking at historical data, .com crash, 2000–2002, Nasdaq fell 78%. Financial crisis, 2008–2009, S&P 500 fell 57%. COVID crash, 2020, S&P 500 fell 34% in weeks. Each time, those with cash were able to buy quality assets at distressed prices. Buffett doesn't know when the next downturn will come. It could be next month, next year, or 3 years from now. But he believes, based on historical patterns and current valuations, that significant dislocations are more likely than not in the coming years. And when that dislocation comes, he wants to be the buyer, not the seller. The waiting game. People often ask, what is Buffett waiting for? Based on his public statements and historical behavior, he's waiting for what he calls fat pitches, opportunities where great businesses trade at attractive prices. In baseball terminology, a fat pitch is a ball thrown right in your hitting zone. When you swing at a fat pitch, your chances of a home run are highest. Buffett has said in interviews that in investing, unlike baseball, you don't have to swing at every pitch. You can let dozens, even hundreds of pitches go by, waiting for the perfect one. And he's willing to wait, patiently. In his 2023 annual letter, Buffett wrote, "There are periods when we find little that excites us. This is one of those periods." Let's be clear about something. Buffett isn't hoping for a market crash. He's not rooting for people to lose money. He's stated multiple times that he's bullish on America's long-term prospects. But he is a realist. He knows that markets overshoot on both the upside and downside. And when they overshoot to the downside, incredible opportunities emerge for those who are prepared. The key word is prepared. Preparation means having cash available. Preparation means not being forced to sell assets at depressed prices. Preparation means being able to act decisively when others are paralyzed by fear. This is exactly what Buffett did in 2008-2009. Deployed approximately $15.5 billion into Goldman Sachs, GE, Bank of America, and others. 2011, bought IBM when tech was out of favor. 2016, made major investments in airlines, though this one didn't work out as planned. 2020, invested in Japanese trading companies during COVID uncertainty. Each time, critics said he was catching a falling knife or losing his touch. Each time, he was simply buying quality at reasonable prices. And each time, he could only do it because he had the cash ready. Lessons for individual investors. So what can we learn from Buffett's cash strategy? How can individual investors apply these principles? Lesson 1. Patience is a competitive advantage. In his annual letters, Buffett has repeatedly emphasized that patience is one of the greatest advantages in investing. Most investors feel pressure to be constantly active. They think if they're not buying or selling, they're not doing their job. But Buffett has shown that sometimes the best action is no action. Waiting for the right opportunity at the right price can be more profitable than constant activity. For individual investors, this means don't feel pressured to be fully invested at all times. It's okay to hold cash while you wait for opportunities that meet your criteria. Lesson 2. Understand what you own. Buffett famously avoided technology stocks during the dot-com boom because he didn't understand them. He was criticized for being out of touch. Then the bubble burst, and those critics lost fortunes while Buffett preserved capital. The lesson? Only invest in businesses you genuinely understand. If you can't explain how a company makes money, you shouldn't own it. Lesson 3. Price matters a lot. One of Buffett's core principles is, price is what you pay, value is what you get. A wonderful business at a terrible price is a bad investment. A good business at a wonderful price is a great investment. This means being disciplined about valuation, even when everyone else is buying, especially when everyone else is buying. Lesson 4. Maintain cash reserves. How much cash should you keep? That depends on your personal situation, but financial advisors often recommend 20 to 40% in cash or cash equivalents for investors who want to follow Buffett's style. Yes, you'll underperform in raging bull markets, but you'll also avoid major losses in bear markets. Have capital to deploy when opportunities arise. Sleep better at night knowing you're not overextended. Lesson 5. Quality over bargains. Buffett's philosophy evolved over time. Early in his career, influenced by Benjamin Graham, he bought cigar butts, mediocre businesses at very cheap prices. Later, influenced by Charlie Munger, he shifted to buying wonderful businesses at fair prices. The lesson: don't just buy something because it's down 50%. Buy quality businesses when they're on sale due to temporary issues, not permanent problems. Lesson 6. Think in decades, not days. Buffett has never bought a stock thinking about what it will do next week or next month. He thinks about where the business will be in 10, 20 years. As he's famously said, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. So here's the bottom line on why Warren Buffett is sitting on $325 billion in cash. It's not because he's scared. It's not because he can't find investments. It's not because he's too old or out of touch with modern markets. It's because he's being disciplined, patient, strategic. He's following the same principles that have made him one of the most successful investors in history. Don't overpay for assets. Wait for opportunities with a margin of safety. Keep dry powder for when fear creates opportunities. Be greedy when others are fearful. Based on his public statements and historical patterns, Buffett believes that today's market valuations don't offer compelling opportunities, so he's waiting. And when the right opportunities emerge, and based on market history, they will, Berkshire Hathaway will move quickly and decisively. As Buffett wrote in his 2023 annual letter, the stock market is a device for transferring money from the impatient to the patient. That $325 billion isn't sitting idle. It's locked and loaded, ready to deploy when the time is right. For individual investors, the lesson is clear. Sometimes the best investment strategy is patience, building cash reserves, waiting for your pitch. It's not exciting, it's not glamorous. You won't have stories about 10x returns at dinner parties. But over the long term, this disciplined approach to investing has created more wealth than almost any other strategy in history. Warren Buffett has proven this for 70 years, and at 94 years old, he's still following the same playbook. Maybe it's time we paid attention.